you get this kind of really interesting area where the technicals say, this looks terrible, the whole thing's bearish, all the speculators are selling off, and then you can see the investors coming in and they're buying, and you just know that the speculators are going to get wrecked because the floor is put down by the investors who are buying it up. When I look at the network, there's so many different metrics you can look at, and they all get used in different parts of the cycle. And currently, the most reliable metrics are the views into demand and supply, both locally and in the macro sense. So, I'm looking at a chart right now in front of me, and it's looking at what the long-term investors are doing. And so, for example, I work with Glassnode, which does the raw on-chain data, and they process it, and it's a service that many people can use. I pull that in, and for example, they do a metric called liquid supply, and you can look at the blockchain, you can see the millions and millions of addresses, there's multitude of addresses, and then they do the hard work of going, these addresses, who owns them? And they can cluster these addresses into what looks like entities, individual participants that have their wallets spread across all these addresses. And then they look at the interactions between them and the historical interaction. And this metric is very, very telling because they can categorize the guys that buy. They buy without selling. They're 75% of their transactions are more Bitcoins coming in, very few leaving. And then they have another category which is liquid and highly liquid, and those guys are more speculative. You look at their history and they buy and they sell and they trade. We can kind of look at that movement between speculative hands and long-term holders, and obviously as all the supply moves to the long-term holders, the guys that do not sell, you create a huge supply shock. There's a shortage of coins left by the speculators and the price just runs up. And so that's kind of like a demand and supply view using their historic behavior, and so that's one of my favorites. Another one is just share, doing the same thing but much rougher. You say anything in a wallet held by self-custody or cold storage, those are the coins you cannot buy, and the coins you can buy are the coins that are left on the exchanges. And you can run that ratio and you get the similar kind of metric, and that's demand and supply also. The supply is what's on exchanges, and the demand is that is held by investors who've got that locked away in cold storage. So those kind of metrics are the most telling and reliable because I cut my teeth using volume on the network because that was kind of like a proxy to buying and selling, right? There's a direct relationship. If I'm going to buy some coins off someone else, they're going to send it to me, and you can read that volume moving into my wallet as a trade. And so the more trades you get, the more investors are coming in. So you can look at volume as a proxy to the investment activity, and some of the early stuff was based on that. My first metric, which was the first on-chain signal for Bitcoin, was NVT, which just ran the ratio of that essential volume between investors and the market cap. Very much like price earnings ratio. You have the share price and how much earnings that company had. You can run a ratio of its valuation. You've got now in Bitcoin land valuation, the market cap of Bitcoin, and how much investment activity is going, which is the sheer volume moving between investors. And that became NVT ratio. And you can see oscillations, when it's high network activity by investors and very low valuation, then it's undervalued. So that's another thing we can do, but it's less reliable than this latest generation stuff, which, it's the network keeps changing. And when you look at sheer volume, you cannot see, what we've seen in the last 4 years is a mass migration of transactions moving to behind the firewall of exchanges. And you cannot see what the investment activity is really happening inside those exchanges. So you're losing signal. Yeah, that's another thing around this on-chain field is it's constantly changing because the network's changing. We're now moving into an era when we have layers above the base chain, whether that be exchanges or the popular thing right now is Lightning Network. So now there's a certain amount of transactions moving to that network that's above the base layer, which we cannot see. Those are examples where things change all the time, and you really need to understand what's happening with the network in order to account for it. The price action of an equity or any commodity is driven by speculators over the short term. And so the price can go anywhere in the short term based on this short-term speculative demand and supply. But what we look at here, like the analyst that goes into a Fortune 500, is we look at the fundamentals. I'm not interested in what the speculators are doing. I'm interested in what the investors are doing and the length of the time they're holding. That's like looking at, the next Apple iPhone or whatnot, because like you're looking at long-term fundamentals of, will this company be profitable? Not trading these tiny speculative signals. And so this stuff is much more reliable, but it's more reliable on the longer time frames, in the multiple weeks to the macro cyclical nature. Over the short time frame, speculators and that technical analysis on the exchanges become very much dominant, but there is this kind of intersection over multiple weeks. Maybe I put it like maybe 2 to 3 days if you really good. With the latest metrics, we can get it down to a few days into the weeks where that sort of area meets technical and fundamental, the on-chain stuff. You get this kind of really interesting area where the technicals say, this looks terrible, the whole thing's bearish, all the speculators are selling off. And then you can see the investors coming in and they're buying. And you just know that the speculators are going to get wrecked because the floor is put down by the investors who are buying it up. And we've seen that a number of times. What was just over a month or so ago when we were testing the $29,000 range, and everyone said it was going to 25 to 20,000 or even lower, and there was unprecedented amount of accumulation, and there was no way that could have dropped down to 20 at least. Maybe 25 would have been possible for a speculative, short-term drop, but long-term, it was a very reliable signal would go up. And you can see these kind of things that happen where the technicals, they're wrong. I find technicals maybe a 60% reliable, whereas the on-chain, when doing it well, you can get about 80% reliable. It is when the two disagree, the fundamentals have precedence. And so, yeah, I find that now if you are either an investor or even a speculator, you need to have some sort of look on-chain to see what this other stuff is doing.